All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to talk about Deere, okay, and go into the John Deere stock. It's an incredible company, but it's still a cyclical stock. So we're going to go over, a few things about John Deere. They are pioneering the next huge phase of productivity growth in agriculture since the first tractors were brought to the market. Tractor autonomy, see and spray technology, drone usage, digitalization, and electrification drive DE's Leap's ambitions. The Leap's ambitions will reduce DE's cyclical sales cycles, with the company estimating 10% recurring revenue by 2030. While share prices are around all-time highs, remember, DE is still prone to cyclicality. Wait until a downturn in demand to buy DE shares. So we're going to go over DE, but first, remember, the content provided in this YouTube channel is for informational and educational purposes only. It is not intended to be relied upon as legal, financial, or investment advice. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer. We'll go ahead and move forward and talk about the investment thesis here. So Deere & Company, which is ticker symbol DE, is historically a cyclical company that experiences swinging sales cycles depending on demand for equipment from farmers and construction companies. For example, I find that Deere's share price is correlated with farm income and well as operating margins. 2022/2023 is a culmination of farm income as well as Deere sales and margin expansion. However, to offset future cyclicality, the company is implementing its LEAP strategy, in which management expects 10% of 2030 sales to be through incredible autonomous SaaS products. I believe these products will dramatically increase the productivity of farming and will therefore be an immense value add for farmers and consumers around the world. But until then, I believe investors should wait until the next few years play out, since Deere does not have a good margin of safety for a potential recession at its current $110 billion valuation. All right. And you can take a look at some of the stats here. All right. And its sales growth over the few years. And, just really take a look there. You can see some of the positives and negatives, and kind of the cyclicality of it that we're speaking of right here. Now, based on a quick overview of two important financial performance indicators, we can see that DE does not experience steady sales growth. Furthermore, when sales decline, so do returns on invested capital. The cyclicality arises from the cyclicality in farmer income. If we match DE's data with the following time series of U.S. farmer cash flow and income since 2002, we can see a clear correlation. Right. And so that's what we're looking at here. The orange/yellowish line, that's going to be net cash farm income. And, then we have the net farm income here in blue. All right. And you can see basically how these, correlate over here on the previous chart with the, sales growth and the ROIC for ticker symbol DE, right? Now, notably, as the farmer's bull market reached an inflection point in 2012, so did DE's capital returns. USD forecasts that farmer incomes will decline by an inflation-adjusted 18.2%. Although the forecasted decline will leave farmer incomes above the long-term average, the trend should be alarming for investors who are considering buying shares in DE today. The unprecedented increase in returns as well as sales for DE is expected to continue throughout 2023, but investors should be wary about a market slowdown that could lead DE to miss its target guidance of 8.75 to 9.25 billion of net income for fiscal year 2023. Furthermore, although the outlook for DE's 2023 is still strong, the company could experience an even larger slowdown in 2024 and/or forward. I believe that an eventual slowdown in farmer income and John Deere's main operations are the perfect chance for investors to buy into the company's long-term LEAPS ambitions. Now, the LEAPS ambitions, the overarching theme of the LEAPS ambitions is do more with less. The most exciting of the ambitions is Deere's fully autonomous tractor. Economically, this innovation should vastly increase farmer productivity for several reasons. First, the farmer will not need to be present for certain parts and eventually all parts of the production process, giving the farmer the chance to perform other value-added activities while the tractor farms. Second, the tractor will be able to operate for longer hours. Even in the dark, fully autonomous can perform tasks that the farmer would not be able to complete. Third, the cost of seasonal labor should decrease over time, thus improving the farmer's margins. If the company can successfully drive customer adoption, then the autonomous tractor will be one of the century's most essential innovations. As of recent announcements, Deere is planning to offer the autonomous driving feature as a usage-based subscription service. This product will likely be the largest component of Deere's eventual subscription revenue going forward. In my opinion, substantial revenues from this product will most likely not come to fruition closer to the year 2028, as farmers' digital adoption will likely be slow. A product, though, that is taking substantial share already is See & Spray. The company sells a boom that sprays only weeds and other unwanted plants in the fields, which has the power to significantly decrease the farmer's input cost. The company is also testing alternative spraying devices that reduce the pressure and weight released into the farmland due to large agricultural products. These products come in the form of the company's joint venture produced volocopter drone, signature Deere drone, as well as, what do you call this thing? The implications of an autonomous subscription model. John Deere projected that 10% of total revenues will be made through subscription services in 2030. The company briefly mentioned this, but has not given any concrete guidance as to how its go-to market strategy will change with this new business model. This makes it difficult to estimate revenue projections into 2030. For example, with the subscription service, will John Deere own the fleet of tractors that the farmer operates and only charge the farmer for leasing as well as autonomous-based consumption? Or will Deere sell and finance the tractors like they're doing now and simply charge an extra fee for the autonomous-based consumption of the vehicles? I believe that we will continue seeing the original latter strategy over the next decade, but with a new focus in mind. During the Leaps Unlocked presentation, Deputy Financial Officer Joshua Jepson highlighted that we're not simply focused on driving units, but instead on increasing the value each machine delivers over its lifetime. The goal is to achieve an average of 20% throughput margins by 2030. Deere, as a matter of fact, is already implementing this business model with the See & Spray product today. The purchase of the machine is made at the point of sale, while the AI-enabled pesticide sprayer is charging on a per-acre usage basis. In the coming years, Deere will equip all of its tractors with autonomous functionalities that will be available for any farmer to use on a subscription basis. This means that tractor and tractor equipment sales will not be lower at the expense of the SAS model. Now, below is a revenue projection model with 3 sensitivity levels for Deere's production and precision ag business unit. Since 2020, the company began reporting this as a separate unit, which was before aggregated into a unit called Worldwide Agriculture and Turf. This business has an expected revenue CAGR from 2020 to 2023 of 27%, with an incredible margin expansion that will result in around 48% operating profit CAGR over the same period. These results have been incredible, in part due to low baseline during the pandemic year and high pent-up demand due to record high farmer income during 2022/2023. For this reason, I do not believe the CAGRs can be used for a forward-looking projection for the 6 years following 2023. Because of the uncertainty going forward, the sensitivity model can be used to gain some perspective. 2023 sales for Deere's production and precision ag business will also be at record highs. Therefore, it will be difficult for the company to generate a high sales CAGR going forward. Therefore, I believe the CAGR will lie somewhere between the pessimistic and neutral case, where we can expect slightly below a doubling of equipment sales by 2030. Furthermore, I've included SAS sales to be 10% of equipment sales in each scenario, which yields a meaningful bump in sales. And, this is it right here, essentially, okay? We can take a look at some of the historical data here, the equipment sales, SAS sales, operating profit, and we see the pessimistic, neutral, and optimistic projections right here, okay, with the neutral being about 13% for sales, operating profit at 15%, pessimistic at 3% and 5% for sales. You can pause the screen and take a look at that graph in that chart right there. Now, one important implication of SAS revenue is that operating margins on those offerings should be high. In the best case scenario, this should lead to an even stronger margin expansion. Since John Deere is still an incredibly cyclical company, the scenario which comes to fruition will be heavily dependent upon the broad macro environment, economic environment, farm income, farm subsidies, inflation, and more. Nonetheless, if Deere lands in neutral to optimistic case, then a corresponding stock appreciation will follow. John Deere's share price and its operating margin tightly follow each other, right? And we have that over here in this graph right here. We'll dive into it a little bit more, but John Deere's share price and its operating margin tightly follow each other, as I just mentioned. Furthermore, I would like to point back to the beginning of this article showing a graph of farm income. The great financial crisis in 2008 was followed by an extreme growth in farm incomes, which also correlates well with this graph. Then farm incomes fell steeply in 2014 and remained at low levels until 2019. And finally, we can see that recently rising farm incomes and operating margins for Deere have led to an incredible share price appreciation. The implication of lower farm incomes is henceforth a lower demand for ag equipment and slower sales growth. Moreover, as inflation continues to ease, Deere will not be able to continue rising prices so substantially as they have been doing during the previous years, and therefore we can expect to see a retreat in operating margins. This will most likely culminate in a share price reduction during the short to medium term. And so here's that price of DE here in purple, and we see the trailing 12-month operating margin here in orange and how closely correlated those are related into performance of the stock, right? We see the decline here, we see the decline in the price of the stock, then we start to see this increase and we start to see the stock increase, and this starts to level out a little bit, this starts to level out. We see this go down, we see this go down, and so they are very closely correlated when it comes to the operating margin and the price of the DE stock. Now, in conclusion, John Deere's historical performance has been closely tied to the cyclical nature of the farming industry, resulting in fluctuating sales growth, operating margins, and returns on invested capital. While the company is currently experiencing a period of growth and margin expansion, I am concerned about the company's vulnerability to potential market slowdowns and a decline in farmer income. Therefore, I consider DE a hold until it can be purchased for a higher margin of safety, especially considering that Deere stock was flat between 2012 and 2017 due to depressed farm incomes and lower operating margins / ROIC, return on invested capital. John Deere is addressing the cyclicality of its business by creating incredible products such as See and Spray, precision planting, and completely autonomous farming vehicles. I believe that this set of products will be the most revolutionary since the tractor replaced horse-driven farming, and therefore want to emphasize my belief that DE stock is a strong buy over the long term. All right, now hopefully you enjoyed this video. Smash that like button, subscribe to the channel if you guys are new, and I'm out.